Hello everyone, today with MarketXLS we're going to talk about the strip strangle option strategy. MarketXLS is one of the top Excel-based investment research solution for investors. In this video we'll be discussing what a strip strangle is, how it works, and how it is calculated using MarketXLS. So without any further ado, let's start with the topic. A strip strangle is best implemented when you expect the underlying security to experience significant volatility in the near term, and is more likely to plunge downwards instead of rallying up. It is a modified and a more bearish version of the long strangle, which buys more put options than call options. A strip strangle is an unlimited profit and a limited risk strategy. What we do in this strategy is that we go long on the out-of-the-money call option as well as on two out-of-the-money put option contracts of the same underlying security and expiration date. MarketXLS offers a template for this strategy. Here's an introduction page for the users to read, and here's an active template, where the cells in yellow have to be inputted by the user. So the stock ticker, expiry date, and the out-of-the-money strike prices for the put and call. Some upcoming expiry dates are available for reference on the side. And for the purpose of this video, we'll be using Microsoft expiry date as 25th June. And the out-of-the-money strike prices for the put and call are $250 and $270. We've bought two out-of-the-money $250 put as well as one out-of-the-money $270 call option contracts of Microsoft. We've built the net debit strategy and paid $46 to enter into the trade, and this is reflected in the net cash flow section. MarketXLS has many templates just like the strip strangle one you see here, and it refreshes all the data when you click on Refresh All. A payoff schedule and a payoff diagram are available in the template too. They can be used to analyze the maximum gain, loss, and break-even. Maximum profit for the strip strangle is unlimited and is attained when the underlying stock price makes a strong move, either upwards or downwards at expiration, with greater gains to be made with a downward move, as shown by the green boxes. Maximum loss is limited to the net premium paid to enter into the trade and occurs when the underlying stock price on expiration date is trading between the strike prices of the call and put options purchased. At this price, all the options expire worthless and the options trader loses the entire initial debit taken to enter the trade as shown by the red box. Coming to the break-even point now, there are two break-even points for the strip strangle position: the upper break-even and the lower break-even. The upper break-even point is equal to the call strike plus the net debit, and the lower break-even point is equal to the put strike minus the net debit divided by the number of put options over the number of call options. That is all for today. We hope you learned how the strip strangle works using MarketXLS. If you want to read more about this topic, please visit the MarketXLS website, which has hundreds of blogs and templates. If you want to get in contact with us, please book a demo and we'll be happy to help.